it. Got it. Okay, so another thing trending right now in the news is interest rate is at its lowest. People think interest rate is zero. And I tell people it's no one is going to lend you money and have 0% interest on it. But you guys are
Really?
the experts here.
Look, we would like to. Shoot.
Can you guys clarify that? I mean, it's good, but I mean, you are the expert. Tell me what's going on with interest rate.
I mean, interest rates, I mean, and I think we'll all touch on this. Interest rates right now, they are fantastic. They're extremely good. I think the one thing that, you know, when the Fed had dropped the rates, the one thing, that was the main thing that consumers were coming out saying, oh my gosh, the rates are going to be good. Well, home equity lines of credit, fantastic. Credit cards, fantastic. But when it came to mortgage rates, all of us, we saw that great week that we had to where rates had dropped. And then the next week it was, what exactly is going on? What exactly is going on right now? So interest rates, they're really, really good. Obviously, everything is transactional, but if you're in the market to purchase or refinance or even do some cash out, I think all of us would tell people, you know, it's a fantastic time to look at those options to see how you guys can save money for yourselves and your family as well.
Okay.
The rate are not only governed by what Fed has done. It is a global market. A lot of other factors are governed by that. So yes, when they lower it down, it's going to affect some other commodities and everything else. But yes, the mortgage rates does not directly affected by the Feds.
So is it zero for real?
No.
Okay.
No.
So that's a common misconception. So what the Fed doesn't set interest rates for consumers. The Fed sets the interbank rate. So basically the cost that banks lend to each other. Okay. So what happens is if because, you know, banks are required, and this might get too deep, I'll try to summarize it real quick and you guys would jump in, of course. If, you know, banks are required to keep a certain amount of money on reserve. In order to extend loans, they may have to, you know, borrow money from other banks so that, you know, they're in compliance as far as, you know, the different rules and regulations they have. So what happens is when Fed drops the rate to zero, they're basically saying, you know, if Bank of America wants to borrow money from PNC, there won't be an interest rate. You just basically pay back what you borrow, period. So what happens is usually you see a trickle-down effect. Well, if the banks can borrow money from each other at a lower rate, well, then that means that bank now has the ability to go a little bit lower. So then they're going to offer it to their consumer a little bit lower just so that they can get business. Well, then the next bank turns around, does the same thing, and it's essentially the opposite of a bidding war. You're just going in a downward direction. But there's still going to be interest on the money. At the end of the day, though, what happens is there's so many other factors, and I think April was a perfect example. There's so many other factors that play into the interest rates: stock markets, treasury bonds, mortgage-backed securities, consumer confidence, that all that kind of mixes together like ingredients in a cake, and the end result is essentially the mortgage interest rate. So, you know, I'll kind of wrap up here real quick, whereas, you know, for certain credit profiles, rates are phenomenal, right? But the problem is that a lot of people who may not be that quote unquote ideal customer, the adjustments to the interest rate, such as credit report, LTV or loan to value, the program itself, all those things compound to the point where, you know, if you're on the lower spectrum of, you know, the credit score, not putting any money down on conventional financing, your rate may be abnormally high based on where you would perceive it, but that's just because of the market and the climate that we're in. So once we get past all of this craziness with the virus and things get back to quote unquote normal, then you should see rates stabilize. You should see things get back to normal, where across the spectrum, you should have very competitive rates for everyone who qualifies. But right now, those really, really good rates are for a very specific credit profile.
Okay.
Because for the lower credit, it's a more risk factor. Banks are really tight. They don't want to lend it to everybody else.
Yeah, and I think Mr. Gupta said it best, and Gary, really, that was great. I mean, he explained it perfectly, but basically, and what we call it in our business is that you kind of you're basically pricing the product out of the market.
Exactly.
So it's kind of, and I know we all do FHAs and different loans of that nature. It's like, well, yeah, we do have 3.25% available for 5.5 points. And the customer is kind of saying, well, why does that cost so much? Because your credit profile is that it's so risky right now based upon the liquidity that we have, is that if you're going to get that particular mortgage, you're going to pay for it. Yeah. And I mean, that's really a layman's terms way of explaining it. And all of us have seen those different adjusters with the different credit score profiles. We'll get into underwriting guidelines a little bit later, but that's just something I think as a consumer, it's also helpful because now it realizes, you know what, if this is, who knows how long that this credit market is going to last with these guidelines, it's really an incentive to improve, try to get your credit score above that 680, 700 threshold, which a lot of banks are looking for, so you can put yourself in the best possible